Hey everyone, welcome to Mind Your Business, where we showcase all the latest news in crypto and tech. If you like our content, please don't forget to like and subscribe, and also make sure to hit that notification bell. Let's get into it. In a recent guest spot on CNBC's Squawk on the Street, CEO and CIO of ARK Invest, Cathie Wood, spoke about the current state of the market. Cathie discussed the impact of inflation and higher interest rates on long-duration assets, including ARK's own innovation strategies. She explains how inflation is on its way down and notes that corporations, even those with pricing power, are losing volume, which is a sign that consumers are railing against inflation. Cathie also thinks that the Federal Reserve is doing its part, with money supply growth down around 3% on a year-over-year basis. Cathie also addressed the speculation that ARK's innovation fund is a barometer for what the Fed is doing, saying that the muscle memory has more to do with the tech and telecom bubble and bust. She believes the technologies today are ready for the massive innovation period we're currently experiencing, unlike in the late 90s. Cathie thinks that benchmarks, which represent the traditional world order, are going to be disintermediated and disrupted by the most massive innovation period in history. She's confident that ARK's innovation strategies are well-positioned to benefit from this disruption. Let's listen to Cathie.
The bond market at one point had never performed as you had to go back to the 1700s. So long duration assets were creamed, including our innovation strategies. And it was all because of fears of inflation and higher interest rates. We do think inflation's coming down now. It always seems like it could come down faster, but we do believe it's on its way down. You listen to corporations out there, even those who have had pricing power, the staples, P&G, they get their pricing, but they lose the volume, 6% declines in volume for a staple company. So we do think the consumer is railing against inflation, and the Fed certainly is doing its part, and money supply growth is down. Our estimate is roughly 3% on a year-over-year basis. We haven't seen a decline in money supply since the Great Depression in the 1920s.
So you see these most recent hawkish hand-wringing as the death gurgle of inflation, one last attempt to try to make its voice known?
I think the Fed really wants to make sure that it has done its job, and job owning is part of it. But I do believe the equity market, certainly the way we've started the year, are beginning to see to the other side. And sure, maybe they go up another 25 basis points, maybe 50, I don't know. But I think we're just about there. And the market is a discounting mechanism after all. So if it can see to the other side, then we should be okay.
It was looking like that in January, but then January data all came in really strong, including inflation, with the PCE going in the wrong direction. So the market has sort of changed its mind from your view, and now thinks we're going to have a series of more interest rate hikes, and they're going to have to stay higher for longer, and the economy is going to get hurt worse than expected.
Yeah, this is going to date me. This reminds me of early in my career. In the early 80s, it was the same thing. But those who bet on lower inflation and interest rates long term were the winners. And it's always the data are very volatile, especially when you have the warmest winter in history here in the Northeast. So I think that's distorted the numbers quite significantly. And the interesting thing about seasonal factors, if that is the distortion, they all have to work out to one over the full year. So if they bumped the numbers disproportionately in January, it'll come out of other months.
I don't know. February's a little warm too. Yeah. Some people look at your ARK Innovation Fund, Cathie, as a barometer for what the Fed is doing, right? And they say it's back on the rise. Speculative behavior is back. Unprofitable tech companies are getting bid again. The Fed has more work to do.
It's very interesting that people do link the two together. I think that the muscle memory has more to do with the tech and telecom bubble and bust, and people fearing that we may be in the same situation. We are not. In fact, the seeds for everything that's happening today, all of the innovation that's happening today, they were planted in the 20 years that ended in the tech and telecom bubble. But the technologies back then were not ready. The costs were way too high. We didn't get the big breakthroughs in artificial intelligence until deep learning 2012, transformer technology 2017, and now finally we have a chat GPT. People are beginning to understand that the ground is shifting underneath us when it comes to innovation. Unlike in the late 90s, investors rushed into the late 90s, weren't ready for them. Now they're running away. They really are running for the hills. And what are the hills? They're benchmarks. That's where they think safety is. But if we're right, the benchmarks, which represent the traditional world order, are going to be disintermediated, disrupted by the most massive innovation period in history.
To watch the full interview, check out the link below. Do you agree with Cathie that inflation is coming down? Do you believe that the current situation is a lot like the 90s tech and telecom bubble, ready to bust? Let us know in the comments. If you want to see more content on the world of crypto and tech, make sure to like, subscribe, and hit that notification bell as we put out daily content. Thanks for watching, and we'll see you next time.